All right, desk alert. Time to lock in. What we're seeing in the QQQ right now is not normal market behavior. This is an institutional setup, and you need to pay attention.
So the entire market just flipped. We are in negative gamma. What does that mean? It means institutional positioning is coiled so tight that moves get fast and violent. If you're on the wrong side of this, you get steamrolled. Plain and simple. But if you position correctly, you get paid.
Okay, let's get right to it. QQQ closed at 609.65. That's our starting point. From here, we map the institutional options board to see where the real money is flowing. And believe me, that board is loaded. We need to know exactly where the smart money has put up its walls and where its targets are. So let's map this battlefield level by level.
Just look at this size. We have a massive put fortress right at the 600 strike. 67,000 contracts. Come on, that's not retail playing around. That is pure institutional money defending a key level.
So here's what that means for us. That 600 level is a price magnet. It's a major support zone. Think of it like a concrete floor built by the biggest players on the street. They absolutely do not want price breaking below this level. Now look above us. You've got these call walls stacked at the 640 and 645 strikes. This acts as a hard resistance ceiling. This is where institutions are capping any explosive moves to the upside. So there it is. Our battlefield is defined. Support below, resistance above. We are completely boxed in. This setup is screaming one thing and one thing only. This is a range trade, a premium selling, income-generating day.
But hold on. This is not going to be some sleepy day stuck in a simple range. The game changer here, the critical variable, is dealer positioning. They've just flipped into deep negative gamma, and that changes the entire playbook.
You gotta get this. In a normal market, what we call positive gamma, dealers are like a brake. They sell into rallies, they buy the dips, they slow everything down. But in negative gamma, they hit the gas. They become accelerants.
Yeah, you heard that right. They don't stabilize the price, they chase the price. If the market pushes up, they're forced to buy more. If it drops, they're forced to sell more. It creates this absolutely violent feedback loop.
And what happens when they chase? You get acceleration, expansion. You get these huge explosive candles. And while we're still inside that range, the moves between the levels will be fast. This is the perfect environment for an option seller.
Okay, let's talk volatility. Implied volatility percentile is sitting at 73%. That's high. All that means is options premium is expensive right now. It's jacked up.
And when premium is expensive, what do? We don't buy it, we sell it. We operate just like a casino. We become the house, and we let the probabilities and time decay do all the heavy lifting for us.
And a quick flow check. The calls are dominating, which tells us aggressive buyers are stepping in. And check out max pain. It's the price where the most options expire worthless. It's sitting up at 619, above where we are now. That's a magnet pulling the price up. So our bias is neutral, but with a slight bullish lean.
So what's the play? It's simple. It's professional. We sell both sides of this range. We're putting on an iron condor to collect premium from both the fear of a breakdown and the fear of a breakout.
Here's the exact build. For the downside wing, we're selling the 585/580 put spread. This is sitting right behind that giant 600 put fortress, giving us a high probability of profit. For the upside wing, we're selling the 630/635 call spread, tucked right under that 640 gamma wall.
Now put it all together. You're collecting about $1.42 in credit up front. Your risk? It's defined. It's capped at $3.58. You've got a nearly 50-point wide profit zone. That's huge. QQQ can chop around all week, and you just let theta burn that premium for you.
Okay, listen up, because this part is absolutely critical. You can't just put this trade on and walk away. Every trade requires professional risk management. Let's cover the exact protocol a desk would use here.
The DIR, that's the dealer intensity rating. It's screaming at 6.88. That is high. It's a warning light. It means if we do break one of those key institutional levels, the move will be sharp and it will happen fast.
So how do you manage that risk? Easy. You size small. 1, maybe 2 contracts. That is professional sizing. We trade to survive and stay in the game, not to swing for the fences on one single trade.
And this is the pro mindset you need to have. We are not trying to guess the direction here. We are selling fear. We are selling volatility. We are letting the institutional structure and the math do the work for us. That is how a professional desk trades.
So if you want these institutional desk setups delivered to you every single day before the big move happens, not after, what do?
It's simple. Subscribe right now and make sure you turn on all notifications. Every morning, I'm here breaking down exactly where the smart money is positioned and giving you the actionable trade setups to get aligned with them. This is how you trade like the desk, not like the crowd.
This is Elite Trade Radar. We hunt edge daily. I'll see you on the next alert.